Another area in which government can fail is in the creation of moral hazard. Moral hazard is a situation in which you create incentives for bad behavior, typically by protecting people from the negative consequences of their actions. It is a common problem in insurance markets if the person insured has some control over the risk of the covered event happening. For more on this in a market context, look at the video on information asymmetries. The same situation shows up, and I suggest probably more often, in the area of government policies. We'll consider two similar cases. First, the case of unemployment compensation and welfare. These are designed to help protect people from suffering if they happen to lose their jobs or have a very low income. While it is true that people don't have complete control over their income or whether they get laid off, it is also certainly true that some behaviors are more likely to lead to those outcomes. For example, we know that dropping out of school has a significant negative impact on your earning potential. Similarly, not putting forth much effort at work makes it more likely that if there is downsizing, your name will be near the top of the list. But the welfare system and unemployment compensation schemes protect you to some degree from the downsides of this happening. As such, it creates an incentive for people to drop out of school or to slack off at work. To be clear, it would be unreasonable to claim that without welfare, no one would drop out of school. There are a number of reasons that people would make that decision, and the existence of welfare may not be something that too many people consider when they make the choice. The point is that on the margin, that is, for that group of people who are on the edge between staying in school and dropping out, the existence of welfare can be a deciding factor. Second, the case of corporate bailouts. Occasionally, a large company will run into financial trouble, and the government sometimes decides that rather than allowing the company to go out of business, they will bail them out, normally in the form of providing them with loans or investing in the company directly. In this case, the expectation of bailouts creates incentives for companies, especially the large ones who are most likely to get a bailout if things go wrong, to take risks that they would not be willing to take if they had to bear the full responsibility for things going wrong. Take, for example, the bank bailouts during the 2008 financial crisis. The banking system was in trouble because it had made lots of fairly high-risk loans in the form of subprime mortgages. As interest rates had been rising, fewer people wanted to buy homes, so housing prices had stopped rising very fast. Many of the subprime mortgages were also adjustable rate, which meant that their interest rates increased as well, leading to higher payments which many people could not afford. So people stopped paying their mortgages, and banks were left with serious problems. But never fear. The Federal Reserve and U.S. Treasury stepped in to provide the banks with funds so that they didn't have to worry about going out of business. After all, the banks were too big to fail. If we let them fail, it would have caused serious consequences across the economy. So, in the words of President George W. Bush, he abandoned free market principles to save the free market system. On reflection, though, the decision to bail out the banks are a classic example of the kind of policy that creates moral hazard. With the expectation of bailouts, there's no reason not to make risky loans. Risky loans pay higher interest rates if things go well. If things go badly, the government will bail you out. There is no downside. It's like your rich uncle telling you that if you go to Vegas, you can keep anything you win and he'll cover all your losses. Naturally, you're going to take a lot more risks than you would if the losses fell to you as much as the winnings did. In all of these cases, we can understand, usually fairly easily, why the policy was implemented in the first place. Relieving the suffering that comes with poverty, or preventing the economic problems that comes with widespread bank failures are understandable motives. However, we should also keep in mind the incentives that these decisions create.